Hey, happy Thursday, everybody. Paulo Brantz with your weekly interest rate insight. Now, clearly, I am not at my office unless you guys think this is my kind of decor. I did a little remodeling to the house. How do you guys like the colors? Pretty nice, huh? So Danielle and I were actually in Las Vegas at a mortgage convention, and I wanted to take a minute just to kind of share what has been going on in the last week, because it's certainly been a roller coaster with interest rates. I think out of the last 5 days since my last market update, 4 of the days we had a locking bias, which means rates were more likely to go up than go down. But you know how I always like to begin these weekly insights. I always want to give thank you to you out there that referred your family and friends to us. It means a lot. So I want to give you a Las Vegas thank you. It means a lot that with your trust, and we had met some great people last week. So keep them coming. So thank you so much. All right, let's talk a little bit about interest rates. What do you say? So if you're going to take a look here, purchase rates are relatively the same, except for conventional interest rates. We did see an uptick. Now, refinance rates, VA stayed the same, but FHA and conventional were up. Now, this doesn't really show you the true story because we've had a good couple of days with interest rates. If we did this video, let's say on Tuesday, all those areas would have been up and probably 0.25% higher. It's really mood swing right now where it's up and down. It's really tough to buyers to really budget their purchase because one day rates could be one thing, the next day the rates could be completely something different. So what is driving these interest rates? So let's go back. Before we begin, I do want to send a reminder out there. Right now we're getting a lot of escrow analysis that's occurring. So if you do receive an escrow analysis and you do receive a large check with it, why don't you go and take a picture and send that over to us? I want to make sure it's not an escrow refund, and then you and I will talk about it from there. All right? Sounds good. All right, let's get back to interest rates. So it started off last week. We had some good news with personal consumption expenditures. That's PCE. That's the Fed's favorite measure of inflation. In fact, we did expect that it was going to have an increase in inflation. However, it didn't increase as much as the market thought, which was very positive for bonds because remember, PCE measures inflation, so inflation looked like it was cooling down, and in lower inflation markets are really bond friendly, and we saw interest rates improve. Then came the next day where Fed members started talking about how they think there needs to be 2 more hikes, 1 more hike. In fact, I think Michelle Bowman, if I have her name, Michelle Bowman called for 2 more hikes. The market did not react to that well because that's inflationary. No bond trader out there, because that's where 30-year fixed rates come from, is mortgage bonds, want to trade a bond that is not going to be profitable in the future. So if there's expectations of inflation, you're going to have to get a higher price for that bond and a higher interest rate. I love Austin Powers. I too like to live dangerously. All right, that's enough of that. Let's move on here. All right, then also to further increase interest rates, the JOLTS report came out. Now, JOLTS report is job openings and labor turnover survey. The expectations were highly surpassed, which indicates a very strong a stronger than expected labor market. When you have a strong market that is inflationary, because what happens, think about it, if the job market is strong and people can't get people to work, they have to pay more for those employees. Now that cost of that employee gets passed to you through goods and services that they provide when you buy them. So that definitely did hurt interest rates. Now, one thing I did not bring up was ADP. So ADP came out, I think it was yesterday or 2 days ago, and this really helped bonds because it really missed its expectations. There was let me just take a look here. It showed the slowest pace of private sector jobs growth since 2021. When that report came out, a lot of those losses that we received with interest rates were taken away. And so right now, that's why we're kind of seeing almost even with last week. But tomorrow, my friends, is what we're anticipating. It's the jobs report, BLS report. And what we're expecting is, let's see here, job creations of 170,000. unemployment rate to drop from 3.8 to 3.7. If we miss those expectations, you're going to see a push in interest rates going further. Now, it's really one of those things where to get a better interest rate, you're almost hoping that somebody loses their job. So it's not a great thing we like to talk about, but I just want to keep that in perspective. So keep that in perspective. All right. I think that covers it up here. You know, I always want to share with you guys if you're thinking of making any changes. I know, especially if you're my client, I know I got you in great interest rates, but I never want to assume there's nothing we can't do for you. If you're having any issues with your servicer, you're thinking of making any changes, your credit card debt, you have a kid that is thinking about, maybe buying a home, let's schedule a hopes and dreams conversation. We're not going to pull credit. We're not going to have applications. We're just going to set down your goals and to really figure out how to achieve them. So with that, my friends, I'm going to go back, enjoy a little bit of Vegas here. And until then, I hope you have a wonderful week. It's Paulo Brandt's Clear to Close Brokers with your weekly interest rate insight. Take care. Bye now.